Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at safe and green holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. This is a story of radical corporate surgery.
Radical is, wow, putting it mildly. What you've laid out here details a complete intentional pivot.
It is.
This company was deeply invested in the modular home construction business, and they've not only restructured, they have formally exited that entire segment.
Exactly. It's a scorched earth policy toward the old model.
And when we say pivot, we have to talk about what they were pivoting away from.
Right. And it was a massive failure. I mean, if you look at the last reported financials for that modular construction segment, it was burning capital at just an incredible rate.
What kind of numbers are we talking about?
We're talking a deeply negative gross margin, something like negative 63%.
Wow. So minus 63%. That's not just underperforming.
No, that is value destruction. Every single time a product is sold, they're losing money. Continuing that business just meant, guaranteed insolvency.
So they hit the eject button and shifted entirely to an integrated energy platform. It's all centered on their subsidiary, Olenox.
A huge shift from construction to the oil patch.
So what's the core reason to believe this new direction is viable? I mean, beyond just chasing higher oil prices.
It really comes down to specialization and their proprietary tools. Olenox's strategy is explicitly not about risky exploratory drilling.
Okay.
Instead, they focus on acquiring thousands of older, underperforming oil and gas wells. In established regions, think Texas, Kansas, Oklahoma.
So these are the wells that have kind of plateaued, the ones major producers have left behind.
Precisely. They're buying up the wells others have deemed too difficult or, frankly, too costly to maintain.
And what do they bring to the table that changes that whole equation?
Their key advantage is proprietary downhole tooling, stuff designed specifically for revitalization.
Okay, so how does that work?
Well, when a well slows down, it's often because of, paraffin or scale buildup, sediment clogging the openings.
Right.
Traditionally, you might use harsh chemicals or these really expensive and slow mechanical processes.
And their tools just streamline that whole process.
Exactly. They deploy two key high-tech assets, an ultrasonic cleaning tool and a plasma pulse tool.
Ultrasonic cleaning. That sounds interesting.
Yeah, it uses high-frequency vibrations to just shatter all that scale and clean the inside of the well bore. Very efficient. No harsh chemicals.
And the plasma tool.
The plasma pulse tool goes even further. It uses these controlled shock waves, a sort of mini non-destructive explosion, really.
Yeah, do what exactly?
It actually increases the permeability of the rock formation itself. It gives the oil a clearer path to flow again.
So it's like high-tech rehabilitation for aging infrastructure.
That's a great way to put it.
The whole pitch is that they can reactivate dormant production way more efficiently than standard maintenance.
Yes. And that brings us to the projections.
What kind of revenue turnaround are they projecting if this technology, works as advertised?
The targets are transformative. And they're really the core of the whole bullish thesis.
Okay.
The company aims to achieve a production rate of 1,000 barrels of oil equivalent per day by the end of 2026.
1,000 barrels a day. If they hit that, what does that translate to in terms of revenue?
If they meet that goal, based on current commodity prices, you're looking at an annual gross revenue run rate of over $25 million just from production.
And what does $25 million in top-line revenue do to those, abysmal negative margins we started with?
That's the fundamental value proposition right there. It creates a complete flip.
How so?
Oil and gas operations, especially optimization like this where you avoid the big exploration costs, typically yield very high gross margins. We're talking 70% or higher.
So you go from negative 63 to potentially positive 70%.
Exactly. From destroying 63 cents on every dollar of revenue to potentially creating 70 cents of value on every dollar, the whole company's viability rests on hitting that target.
Okay, which brings us to execution. A good story is one thing, but we need to see tangible evidence that they're mobilizing.
And they are. We have some immediate catalysts that confirm Olenox is moving.
Such as?
A seemingly small but really critical step happened recently. Olenox received its Department of Transportation number, its DOT number.
Okay, a DOT number. Why is that a massive milestone? It just sounds like bureaucracy.
It sounds mundane, but without it, they're essentially paralyzed.
Oh.
The DOT number lets them legally move their rigs and service division assets, the trucks, the trailers, the equipment, with those proprietary tools on public roads, across state lines.
Ah, okay. So before that, they couldn't really move their gear between job sites.
Right. It crippled their service business potential. This transforms them from just an asset owner into an operational mobile service provider.
And what's the immediate financial benefit of that mobility?
It's twofold. First, they dramatically lower their own costs by servicing their own wells.
They don't have to hire other companies?
Exactly. No more paying third parties for expensive workovers. Second, and this is crucial for near-term cash flow, they can immediately start marketing those services to other oil and gas operators.
Just a whole new revenue stream.
A whole new revenue stream. They are actively preparing to hire a sales team for this third-party service division right now.
And management has tied this directly to a timeline for sustainability, right?
They have. Management officially expects to achieve company-wide cash flow positivity in 2026. And a huge part of that relies on revenue growth from those high-margin third-party service contracts.
Let's talk about the human element. Are the leaders backing this high-stakes shift with their own money?
That's a significant positive signal, yeah. We saw that both the CEO and the CFO, they elected to take their entire third-quarter compensation in equity.
Not cash.
Not cash. That signals some serious conviction. They're putting their personal skin in the game.
And I saw something about a personal financial guarantee from the CEO.
Correct. The CEO personally guaranteed a $2 million credit line.
That's a huge vote of confidence.
It really is.
Yeah.
When a leader puts their personal balance sheet at risk to fund the plan, it speaks volumes about their confidence in the outcome.
Let's loop back briefly to the idea of vertical integration. They exited modular housing, but are they using any of that old construction expertise?
Yes, they are. They're leveraging what they call their green steel technology, their containerized construction expertise, but now for energy applications.
Like what?
Think modular data centers, generator enclosures, even containerized micro-refineries. It lets them build out infrastructure for their well sites really quickly and cost-effectively.
And they're marrying that hardware with software, I take it.
Absolutely. They integrate the Makfu industrial IoT platform across their operations. This allows for AI-driven well site monitoring.
So instead of sending a crew out to check gauges,
The system gives them real-time data. It detects subtle changes in pressure, flow, temperature. It lets them predict maintenance needs and optimize production remotely.
which all feeds back into that 70% margin goal.
It does. It's all about minimizing operational expense through automation.
Okay, that paints a really compelling picture. A company with tech assets, management commitment, trying to leverage a high-margin niche, but
But this is where we have to flip the script.
we have to face the brutal financial reality. Every high-stakes turnaround involves huge risk.
That is the essential counterpoint here. The pivot doesn't just erase the deep financial crater they started in.
The historicals are pretty rough.
Extremely rough. Trailing 12 months revenue is only around $5 million, but they reported net income losses of nearly $17 million.
Wow.
And an operating margin that was in the negative 329% range. That is the definition of a fundamentally inefficient operation.
In entering a capital-intensive phase like this requires serious liquidity. What do the metrics tell us about their ability to handle short-term debt?
Liquidity is severely constrained. This is the company's biggest vulnerability right now.
How bad is it?
Look at the current ratio. It's a measure of whether you can cover the debt due in the next year. Theirs is dangerously low, sitting around 0.2.
For listeners who aren't familiar, what does a 0.2 current ratio imply?
It implies that for every dollar of short-term debt they have coming due, they only have about 20 cents in liquid assets to cover it.
You want that to be 1 or higher, ideally.
Way higher. This suggests they are highly dependent on continuous financing just to keep the lights on. Plus, they have high leverage, with a debt-to-equity ratio around 0.63.
So the balance sheet is highly stressed. Is there a specific metric that acts like a warning siren for this kind of distress?
There is. We look at the Altman Z-score. It's a formula that predicts the probability of bankruptcy.
And what's their score?
It's around negative 3.81. For context, anything below 1.8 puts a company firmly in the severe financial distress zone.
So they're deep in that zone.
Deep in it. And we also have to note they have about $8 million in debt maturities coming due in 2025. That's a short-term liquidity cliff they have to get over.
So the stock exists in this incredibly fraught space, the promise of 70% margins on one side and this alarming Z-score on the other.
Exactly. And that explains the extreme historical volatility.
From $1.81 up to over $122 in the last year.
Right. But the current price action seems to be driven by something else, something structural in the market mechanics.
Let's talk about that, the microfloat environment.
This is where the story shifts from fundamentals to pure speculation. While the company has millions of shares outstanding, maybe 5.6 million,
Yeah.
the sources suggest the true public float, the shares actually available for immediate trading, is microscopic, possibly well below 500,000 shares.
500,000. And how does that happen?
It's created by restricted stock, layers of insider ownership, and registration delays after their merger.
So you have a massive short interest essentially trapped inside a supply pool that barely exists. What's the evidence the supply is truly that tight?
The clearest evidence is the cost for short sellers to borrow the shares. The cost to borrow, or CTB.
And what has that been?
That rate has been reported in the extremely punitive range of 400 to 500% APR.
400 to 500%. You only see that when demand to short vastly outstrips the supply.
Right. And you often get instances of zero shares available to borrow at all.
This brings us to the critical time-gated event, dilution. The company needs to issue a massive amount of new shares, but they can't do it right now.
That's the key structural pressure point. They are seeking shareholder approval to increase authorized shares dramatically, up to 3 billion.
But that's currently restricted by Nasdaq listing rules.
Exactly. Specifically, Nasdaq's Rule 5635. It requires shareholder approval for issuing stock that equals or exceeds 20% of the current outstanding shares.
And they need a formal vote to get around that.
Right. That vote is scheduled for December 29th. Until that vote passes and the filings are done, the company cannot legally expand the supply of tradable shares in a big way.
So we have a defined window. Between now and the end of the year, the available supply is locked, and the short position is highly vulnerable.
Yes, vulnerable to even small spikes in buying pressure. The immediate price action, therefore, is based on trading mechanics, not fundamentals.
And that's why we see these crazy speculative price forecasts.
Precisely. This structural imbalance is the reason for forecasts reaching the $15 or $18 range in this tight window. It's based purely on the asymmetric squeeze risk, a classic high-risk, high-reward trading setup. So to summarize for you, Safe and Green Holdings is executing a high-stakes dramatic pivot away from a failed construction model.
Right.
It's moving toward a potentially high-margin energy platform built on proprietary tech. Management commitment is strong. The technology has a real competitive angle.
Right.
But you must recognize the financial reality. The company is highly leveraged, liquidity is extremely tight, that Z-score is very concerning, and the risk of execution failure or massive share dilution right after that December 29th vote is material. It's a textbook high-risk, high-reward turnaround play.
The ultimate question for you, the investor, is this. Does this massive proprietary technology-driven transformation have enough momentum to overcome the severe financial distress and succeed in converting those drilling targets into sustainable, positive cash flow? That success or failure will determine if Safe and Green Holdings transitions from a highly speculative stock driven by trading mechanics today to a fundamentally sound energy producer in 2026. Remember to subscribe, like, and comment below to support our work and let us know what stocks you want us to look into next. Thank you for joining us on Smart Wealth with Joshua.